Right, good day learners. A very big section of the grade 10 syllabus that is focused on in the first 6 months of the year is that of the bookkeeping process. Now the bookkeeping process involves the fact that a transaction will take place. In other words, an event will happen. That event gets recorded on a document, and you would have spent a lot of your grade 9 time in EMS looking at the various documents, but we'll come to revise those in a minute. Those documents, which are the proof that a transaction has taken place, then gets recorded into a journal. Now there are several journals that you have to draw up in grade 10, and the crux of the matter is that you've got to identify entries to know what journals they go in. Once you've got it into a journal, the journal gets totaled. The totals from these journals get posted into the general ledger, and a general ledger is summarized into a trial balance to check that we've done a double entry, a debit and a credit, for every transaction. At the same time though, the totals would have gone to the general ledger, but the individual amounts, where it's applicable, will go to the individual debtors and creditors ledger accounts. And later in the syllabus we will look at how we need to reconcile these two. But at this stage what I want to focus on is this part at the top here, the documents and the journals. It's like drawing up a jigsaw puzzle. You're going to have a piece, which is a transaction, and you have to identify which document would have been used to record it, and then what journal that will be. And just like a piece of a jigsaw puzzle can only go into one place, it's exactly the same with a transaction. It can only fit into one journal. But you need to identify which journals. And that's why I'm looking at the rules under which we draw up these journals. Now first of all, we've got our cash journals, our 3 journals there that involve money. And in many respects, this is the king and the queen and the princess of the journals. As soon as cash is involved, and when we talk about cash, it's not just necessarily physical paper money or coins. A check or an EFT, an electronic funds transfer, a bank statement, all of these also represent cash. So the minute you identify an entry's got cash in, you know it's going to go into one of these. Now if we have a look at it, we first of all have our cash receipts journal. And exactly as the name says, you are receiving money. Now that can be an actual cash, it could be money, it could be a deposit that's paid into your account, or you could be receiving a check. But the important thing, you as the business are receiving money in some form. Now that would have been recorded on either a receipt, where the business will write the name of the person who the money's coming from. It could be an EFT, where the money's been paid straight into your account, which would also be reflected on the bank statement, but your bank statement will reflect any other money that the bank deposits into your account, like for example interest, or if it's cash sales, it could be a cash register slip. So if you see these, and as long as it's associated with receiving, then you know you go to your cash receipts journal. On the other hand, if you are paying money, then you're going to go to the cash payments journal. Exactly what the name says. But you must be paying, and when you pay, you either pay with a check or an EFT, or it could be via a debit order, in which case it'll be reflected on the bank statement. And that's why those are your documents that are associated with. Now I just want to draw attention to the checks. Checks are very old-fashioned, and in today's day and age there's very little checks used in the business world. More and more everybody's using the internet, which is electronic funds transfers. Now because our textbooks are several years old, you're going to find a lot of checks in your textbook, but it's very important as you're gearing up towards exams, and that's why you're working this in your study guides, is that you're going to find more and more EFTs. So if you're receiving the money on an electronic funds transfer, cash receipts. If you're paying it, cash payments journal. And then the third of the journals is the petty cash. The word petty means small. So this is dealing with actual physical money. You'll have actual coins or actual paper money, which will be kept in some safety deposit box, and they'll use it to buy a newspaper, to buy a liter of milk, to buy some stamps, or to pay some wages of somebody. But they're using actual physical money. Whereas in the cash payments, you would be paying with a check or EFT or using a debit order system, so you're using the bank statement. Right, so if a transaction had affected cash, it went into the first group. Now, if it's not for cash, the second group we're going to look at is when we are selling on account, or we call it selling on credit. You're going to have debtors, that's why it's called the debtors journal. Debtors, people that owe you money. So you're selling on account, and you will issue the person that you're selling to an invoice. Now that gets recorded into a debtor's journal. So the minute you see anything to do with selling on credit or on account or issuing an invoice, those are all words that will tell you that you're going into the debtor's journal. If something that you sold in the debtor's journal is wrong, the person doesn't want them, so they return it, then it's going to go into the debtor's allowances journal. You're going to cancel the original sales entry. Sometimes, though, the person doesn't actually physically return the goods to you. They might just ask for a reduction. Maybe you overcharged them, or you forgot to deduct the trade discount, or there was something wrong with the product and you decide to give them a reduction. You're going to give them an allowance. Then we use the debtor's allowances journal. We're giving an allowance to the debtors, so we're reducing the amount they owe us. And the document that we use here is a credit note. When you look at the ledger just now, you'll see that a debtor's ledger, which is an asset account, is going to get reduced. The debtor owes you less. You're going to credit the debtor. So hence the reason why it's a credit note. Now the next division is when we are buying on credit. Remember, if it's cash, it has to go to the first three journals. If you're selling, you're looking at the debtors. But if you're buying, the people you buy from are called your creditors. So if you are buying on credit, then you're going to use your creditors journal. And again, it's an invoice, but you will receive the invoice. The person who's doing the selling always writes out the document. If you think about it, if you go into the shop, they give you the invoice. So when you're buying, you receive the invoice. Again, if there's something wrong with those goods, we don't want it, we're going to cancel it, it goes to the creditor's allowances journal. And we will receive a debit note. Again, following the same as we did with the debtors, the creditor's account, which is a liability, gets minused on the debit side. And you're going to minus from this creditor because if you return the goods or you ask for an allowance or a reduction, you owe them less. And then lastly, there are going to be other transactions that take place in the business world that cannot fit into any of those journals. And we can't keep opening up a whole lot of different journals. So basically, we've got our first set of journals, there's 7 of them that cover specific items. Now, if there's something else that can't fit over, there's some left over. It's talking about candy here. Left over. What are you going to do with it? For example, you might want to write off a bad debt. We don't have a bad debts journal. You might want to charge somebody interest. We don't have an interest journal. If there's things that cannot fit into any of the others, and that's very important, it cannot fit into anything else, then we go to the general journal. If you remember when you draw up all your journals, we always have a sundry column. A sundry for those entries that don't fit into special columns. It's the same thing here. So we could have called this a sundry journal. It's for anything that can't fit in anywhere else. And those will all have a journal voucher. So learners, what is important is when you are going through the transactions is that you've got to identify which journal to go to. Once you've identified it, it's not generally a big problem. Those are like spreadsheets, just normal Excel. You're putting amounts into respective columns, and I'm not focusing on that now. The first point is you need to identify which journal it goes into. So if need be, make a copy of this sheet and use it to guide you. And then once you've done that, do a revision on how to record the entries in the various journals. So good luck, and focus on why you are putting entries into which journal.